Welcome to the deep dive, where we take the information you send us and really try to extract the core signal from all the noise.
Exactly. And today we're looking at a YouTube video you pointed us to. It's called Best 5 EMA Strategy for Intraday New 5 EMA Strategy Revealed. And the channel is Trader CA Mohit.
Right. So our goal here is to unpack this specific intraday trading strategy. It's all about EMA's exponential moving averages.
Yeah, we want to get a handle on, the basic parts, see how it's supposed to work, and figure out if it offers some useful techniques for you, especially if you're interested in intraday trading, but maybe don't want to get overwhelmed right away.
And the video itself, it seems to really push the idea of simplicity, trading with discipline, and also the potential for pretty good reward to risk ratios.
Absolutely. Simplicity and rules seem key here.
Okay, so let's dig in. The foundation of this strategy, it uses two different chart timeframes, is that right?
That's right. You've got the 5-minute chart, which is sort of for the bigger picture, the overall structure.
Okay, the structure.
And then for actually pulling the trigger on a trade, you drop down to the 1-minute chart for that precise execution. Think of it like wide view, then zoom in.
Makes sense. And the main indicator driving this whole thing is the 5-period EMA.
Yep, the 5 EMA. The video explains how to add it. Go to your indicators, find EMA, set the length to 5. Pretty standard stuff.
And it suggests a specific look, a black step line, thicker.
Yeah, the step line thing is interesting. The idea is that it makes it really clear where each candle opens and closes relative to that moving average line. Instead of a smooth curve, you get these little steps.
I see. So it just pops visually, makes it easier to spot the conditions?
Exactly. Quick visual confirmation. So shall we get into the actual setups? Let's start with the call or buy setup.
Okay, so if we're thinking the price might head up, what are we looking for first on that 5-minute chart?
Right. Condition 1. You need a green candle, a positive candle, to close clearly above the 5 EMA line on that 5-minute chart. That's like the initial sign of some upward push.
Green close above the 5 EMA. Got it. What's next?
Condition 2, still in a 5-minute chart, you then need to see a red candle actually open above that same 5 EMA.
A red candle. Okay, that seems a bit weird after a green one.
Well, yeah, it can seem counterintuitive, but think of it maybe as a little pause or a slight pullback. But crucially, it's still holding above that average level. The fact it opens above the EMA, even if the candle itself turns red, suggests the underlying support might still be there.
Okay, so green close above, then a red open above. That's the trigger point.
Almost. That's the signal to take action 1. You draw a horizontal line right at the opening price of that red candle on your 5-minute chart. Mark that level.
Just draw a line across at that price.
Yeah, exactly. That line becomes your key reference. Then action 2, you switch your focus down to the 1-minute chart.
Right, zooming in for the execution. What are we waiting for on the 1 minute?
On the 1 minute, you're now watching that horizontal line you just drew. You need to see a green candle open below that line, and then this is key, close above it.
Open below, close above, like it dipped under, then pushed back through.
Precisely. It suggests buyers stepped in at or below that level and managed to push the price back up past it. That's your confirmation, really.
Okay, so that's the signal. How do we enter?
The entry for a call option or buying happens immediately when the price breaks the high of that 1-minute green candle that closed above the line.
Break the high, and you're in.
You're in. And your stop loss, that goes just below the low of that same 1-minute green candle.
Okay, defined risk right there. And the profit target. The video mentioned aiming high.
Yeah, it talks about a reward to risk ratio of 1 to 4, even up to 1 to 8. So for every, say, dollar you're risking between your entry and stop loss, you're aiming for $4 or maybe even $8 in profit.
Wow, that's quite ambitious.
It is. Though the video does suggest beginners might want to aim for maybe 1 to 3 or 1 to 4 initially, get a feel for it first. But the principle is clear. Aim for winners that are significantly bigger than your losers.
Right. That makes sense.
Yeah.
Okay, so that's the call setup. What about the other side? If we think the price is going down, the put or sell setup.
Well, it's basically the mirror image. Everything's flipped.
There's first condition on the 5-minute chart.
You need a red candle to close below the 5 EMA, initial sign of downward pressure.
Okay, red close below.
Then condition 2, you look for a green candle to open below that 5 EMA. Again, could be the next candle, could be one soon after.
So a little bounce, but it opens weak, below the average.
Exactly. It suggests maybe the sellers are still in control despite that little green candle. And just like before, you take action 1, Draw a horizontal line.
This time at the open of the green candle.
Yes, at the open of that green candle on the 5-minute chart, that's your downside reference level. Then, action 2, switch to the 1-minute chart.
And on the 1 minute, we're looking for the opposite candle pattern.
Precisely. You wait for a red candle to open above your horizontal line, but then close below it.
So I tried to push up to the line, failed, and closed below.
Yep. Shows rejection at that level. The entry for a put option, or selling, is triggered immediately when the price breaks the low of that 1-minute red candle.
Break the low, and you sell. Stop loss.
Stop loss goes just above the high of that same 1-minute red candle.
And the target. Same kind of ratio.
Same idea, aiming for that 1-4 to 1-8 reward to risk.
Okay, so the logic is consistent, just inverted for puts versus calls. The video apparently showed some examples from May 2nd.
It did, yeah, the May 2nd call example. It highlighted a green candle closing above the 5 EMA right around 9:15 a.m. on the 5-minute chart. The very next candle was red, but it opened above the EMA.
So condition 1 and 2 met.
Right. So they drew the horizontal line at that red candle's open, which was around 24:410. Then, looking at the 1-minute chart, around 9:25 a.m., you see it. A green candle opens below 24:410 and closes above it.
And the entry would be on the break of that candle's high.
Exactly. And the video showed the price moving up quite nicely after that point.
And there was a put example later that same day.
Yeah, later on May 2nd. This time, a red 5-minute candle closed below the 5 EMA. Then, a green candle opened below it.
Okay, setting up the put. Line drawn.
Line drawn at the green candle's open, around 224.492. Then on the 1 minute, somewhere between like 10:35 and 10:40 a.m., a red candle opened above that line and closed below it.
The trigger.
The trigger. Entry on the break of that red candle's low, and again, the price apparently moved down afterwards.
It helps to visualize it like that.
Yeah.
There was one more example mentioned from April 28th, another call.
Right, April 28th. This one was slightly different in the description, but followed the logic. It mentioned a red candle at 9:20 a.m. on the 5-minute. The key action was drawing the horizontal line at its opening price, implying it met the open above EMA condition for a call setup trigger level.
Even though the candle itself was red.
Right. The focus shifted to that opening level, then they waited for the 1-minute confirmation. Green candle opens below the line, closes above, and apparently that led to a big move up. It really emphasizes that red candle opening above the EMA step for setting that crucial horizontal line in a call setup.
Gotcha. Seeing those examples definitely clarifies the steps.
Yeah.
Now, the video also included some important rules or caveats, right?
Oh, yeah. Very important. First big one, stop using this strategy after 12:00 p.m. midday.
Just stop looking for trades. Why is that?
Well, the likely reason is that markets often get, quieter or choppier in the afternoon. Less volume, less volatility sometimes. Strategies like this, relying on quick moves and momentum, tend to work better, or at least more reliably, during the more active morning session.
Okay, focus on the morning momentum. What else?
Another key rule, don't take 2 trades in the same direction consecutively.
Meaning, if you just took a call trade?
The next setup you look for must be a put setup, and if you just took a put, the next one has to be a call. You don't take 2 calls in a row or 2 puts in a row.
That sounds like a risk management or maybe psychological rule to prevent chasing.
Probably both. It stops you from doubling down if the market's moving against your initial idea and forces you to wait for a signal in the opposite direction, maybe encouraging a more balanced view.
Right, and there was something about really big market moves.
Yes, good point. The video mentions that if there's been a huge, sharp move, they use that May 2nd call example where Nifty apparently moved 200 points.
Wow.
Yeah, if something like that happens and then a setup in the opposite direction, so a put setup after that big call move, appears quite soon after, you might actually want to ignore it.
Ignore the signal. Why?
The thinking seems to be that such strong momentum might just steamroll over the conditions for the reversal setup. The market might still be overwhelmingly pushing in that initial direction. So in that specific case, you might hold off on the counter-trend signal and perhaps wait longer or look for a continuation signal later. It's about context.
So being aware of the sheer force of the current move. Don't just blindly follow the rules if the context screams otherwise.
Something like that, yeah. It adds a layer of discretion, I suppose.
Okay. And finally, what does the creator claim are the overall benefits? Why use this strategy?
Well, the claims are, it usually gives you maybe 1 or 2 clear entry signals per day, which helps control overtrading.
Fewer, more specific signals.
Right, it promotes discipline because the rules for entry, stop, and target are very defined. And the big claim is that it leads to fewer losses overall while still giving you that shot at high reward to risk ratios. Win bigger than you lose, essentially.
Okay, so wrapping this up, we've dived into this 5 EMA strategy from the video. It uses the 5-minute chart for structure, the 1 minute for entry, all based on how price interacts with the 5 EMA.
Yep. Specific conditions for calls, specific conditions for puts, essentially mirror images. Draw the line, wait for the 1 minute confirmation candle, enter on the break, set the stop.
Plus those key rules. Stop at noon, don't take 2 consecutive trades in the same direction, and be mindful after huge market moves.
And the whole thing is presented as being, relatively simple and rule-based, aiming for discipline and those potentially large reward-to-risk wins.
Yeah, that focus on clear, defined steps is definitely noticeable. It seems designed to provide a framework, maybe take some of the guesswork out for traders looking for structure.
Absolutely. The simplicity could be appealing.
So thinking about the video's own advice, it really emphasized backtesting, looking at past performance, and forward testing, trying it out live, perhaps with small stakes. It leads to a final thought for you, the listener. Considering all that, what practical steps might you take next to really evaluate if this 5 EMA strategy or the ideas within it could actually fit into your own approach to the markets?